Hey, it's Richard with Matthews Wealth Management. It is 2021 and we are going to do our first market update of the year. So it's a little bit less than what we're used to for last year. We don't necessarily have a year to date because it's only 1 month. So I went ahead and threw a 3-month up there so we could kind of see how 2020 ended and what we're seeing differently in January. So it's already been kind of interesting. There's a lot of stuff going on with GameStop and Nokia and Express and all of these crazy short squeezes. We probably won't talk too much about that, but in the midst of that, there's also some interesting asset class movement going on. So we'll just jump right in here. The first thing that we notice is in this last month, the large cap growth, pretty much all large caps have dropped. Actually, we could go and say most mid caps as well, but the large cap growth has been the most stable, and a lot of that has to do with where people are choosing to invest right now, and large growth has been the name of the game for the last year, obviously, if you followed this series at all, but they only lost 0.75% in the month of January. Our biggest loser came from large cap core or blend, depending on how you want to define that, and then large values dropped as well. Mid cap values are up actually on the month, and if you've been in any client meetings, we're in the middle of first quarter reviews right now. This is an area that we were kind of talking about, is that we would pull away from the growth into the mid-cap values, and it's been the right call, which is great to see. So small caps have absolutely taken off, and I think that actually goes and starts pointing into the direction of these short squeezes and people looking for a lot of positions that hedge funds are very bearish on, and that's its own little world. I might do a video on that just because we've never seen anything like this. Well, kind of. Back in the late 90s, we saw something like this. But small caps have taken off 1.7, 2.5, 4.5 on small growth. So a lot of money being made in the small cap region in the last month. Internationals pulled back, and if you followed this, that's kind of an opposite reaction from what we would expect. We would expect to see emerging markets start to pull back quicker, but emerging markets are taking off 3% while we see a -1 on developed international countries. So tips, we're very bullish on tips. I like tips and long-term bonds actually, but tips here, we're up 1/3%. Short terms are flat. We're actually losing in the intermediate and the long-term bonds. Now, obviously, long-term bonds have a higher interest rate risk. Last week, though, Jerome Powell said that they plan to leave rates basically zero forever. No real plan to backtrack on that, at least without ridiculous amounts of notice. High yield bonds are right in the same region as tips, surprisingly. That's not normal, but we definitely want to keep our eye on that. High yields look to be one of the most stable asset classes if you rewind back to last year. Real estate still backing off, gold dropping 2.5%. So if you saw the end of 2020, I did a long 10-minute spot basically on the inflation that we have created, the money printing that we have done. So to see gold back off is interesting. I think there's a silver run that's starting right now, also kind of like the concept of this Wall Street bets and the short squeezes. Now it's kind of silver. They're going after JP Morgan, so we'll see how that pans out in the month of February. But -2.5 on gold actually looks to be a bit of an opportunity. Oil bouncing back strong. I guess that's vaccines, and hopefully we'll get an economy rolling here pretty soon. But all in all, S&P 500 down 1%, and a Dow Jones moderate risk, kind of the 50-50 portfolio, is down 20 basis points. So that's what we expect, right? That's the purpose of having a nice mix of stocks, bonds, real estate, cash, commodities, etc., is you take less loss, and that's what we're showing there. So that looks good. The last quarter, though, this is showing all those big gains that we made, except for intermediate term bonds and long-term bonds. Long-term bonds basically the exact same as the 1 month, so they were flat up until this last month. Also, if you take away October was a strange month, if you remember as well. But everything's up. Small growth up 14% in the last quarter. That's huge. Mid growth up 5.2, and you actually see that large cap core or blend has done the best in the big equities. Emerging markets taken off at 8.5-ish, 2.25 on international. Tips 1.7. Tips are not quite keeping up with the high yield bonds. Again, we kind of want to look at that relationship. Just Tips are supposed to be inflationary, and they have done a pretty decent job of that in the last year. Real estate is up in the quarter, gold is up 3, oil's up 14, and then you see an interesting mix here. So I just talked about down 1 versus down 0.2, up 2.3, up 2.3. So we're actually getting most of the gains and taking on a lot less losses. So that's kind of why it pays to have that diversification. Not that 50-50 is the right mix for everybody, or just in general. That's just what we like to show to give an idea of what diversification is doing. We saw last year that it wasn't just diversification of putting it in different asset classes. It was very particular as to which asset classes you were in and why and what weighting and so forth, because it was a crazy year basically for growth. So we'll jump over to Matthews Wealth Management practice numbers. The best account year to date is just the month of January. So we got one that's up 3.44. We're not doing any speculation on short squeezes or playing any of that. We manage money here. We don't just gamble. So our worst account's down 0.3. Average is up about 0.25%. I do want to keep this rolling from December. I think this is interesting to pay attention to. This was something I probably should have thrown up there, but for some reason I don't want to give away all the secrets of what we're doing here, but we are tracking inflation pretty closely here. So this first one I didn't erase from 2020. And actually having this board up in client meetings has been helpful. But for the year of 2020, January to December, we printed 24.7% more dollars in circulation, and that's inflation. You can space it out over a period of years before it actually hits people's wallets and so forth. So, but it's there. I mean, we have $19,086 billion that existed. And so just for the month of January, now we have $19,560,400 million. So we printed another 2.5% above the 24.7%. So this is a percent of a percent, which is even crazier. So we haven't slowed down, and we haven't even really gotten into the first 100 days of the Biden administration. So we will keep our eye throughout the year on how much additional money printing is going on, because as we saw last year, that 24.7% basically was showing up on the year to date in all asset classes. We only had real estate and oil, and I think large value, mid value were the only two that were, or the only 4 total asset classes that were down in the year of inflation. So crazy start to 2021. We'll track through February, see what's going on with silver and if that comes over to gold and how oil paces. But yeah, stick around. We'll see you next time.